Hey, this is Nick from Income Digs with a QuickBooks tutorial for you today. So this QuickBooks tutorial came from a specific question from some of our students in Real Estate Accounting Bootcamp. Okay, so we have a student who purchased a property in one legal entity, did the renovation, and then within one closing got a refinance for the property and also transferred the deed to another entity. Okay, so what we need to do then is we need to record that purchase on the books of that first company that made that purchase. And then when the refinance happens, we need to record that refinance, put the property on the books of that second company. All right, and then we need to see if there's any difference in cash or in equity that goes between the two. All right, so I'm going to demonstrate that. This is a relatively advanced concept, but stick with me because it is important and this kind of stuff happens all the time. All right, so to demonstrate, I'm going to do some time traveling. I'm going to go back to 2016, do a really simple balance sheet where I almost have nothing going on. All I have is $50,000 in the bank, and that came from me investing that money. Okay, so this business hasn't done anything else. Now, what we're going to do is treat this ID Property Management as like the first company. Okay, so what I'm going to do is I'm going to record the purchase of a property. I'm going to do some renovations to it. Then we're going to do a refinance and transfer the deed to a second entity. Okay, we're going to do this all within one QuickBooks subscription. If you have separate subscriptions, it would work pretty much the same. I like to have it in one because then I can see things right next to each other. All right, so the first thing I want to do is record the purchase of a property. So I'm going to do a journal entry, and I'm going to keep this really simple, okay? Way simpler than any purchase would ever be, just to make sure we're understanding the core concepts. So when I say simple, what do I mean? I mean that I am going to be crediting my building. Let's say that I bought this property for $45,000, okay? So I'm doing my fixed assets here. I'm debiting it to increase it, and then I want to make sure that my business is indicated as ID Property Management. Okay, so there's my building. I bought it for $45,000. Now you might want to put a little bit to land, a little bit to buildings. I'm not going to do that here, but you would potentially want to do that for depreciation purposes. Okay, so I have the building at $45,000. Let's say that I incurred some closing costs, potentially $2,500 there. Okay. So I need to come up with $47,500 at closing somehow to get this property. Okay, so one part of that is going to be a conventional mortgage. Actually, let's do hard money because that might make a little bit more sense, right? So let's say that we got hard money for this property. That's a liability account, okay? And let's say that hard money lender gave me $40,000. Okay, $40,000 to purchase this property. Okay, and actually, let's go even one step further. Let's say that the hard money lender gave me $75,000 because some of that is actually going to be going to my construction. Okay, so $75,000 goes to the loan. All right, so where does that money go that's for construction? You should have a current asset set up called construction escrow, something like that. Okay, and let's say that just $20,000 is going to go in there. Okay, $20,000 goes into my construction escrow, and then the rest I come up with at cash for closing. Okay, so I'm sorry, that would actually be me getting cash for closing. So let's just adjust this a little bit. Let's say that $30,000 goes in there, and that means that my cash for closing is actually going to be a negative $2,500. Okay, so $30,000 in renovations goes in my escrow, $2,500 in my from my checking account. All right, so this is the purchase, the initial purchase. I'm going to take this property, I'm going to renovate it, and then I'm going to cash out my hard money lender into a new property. So here's my balance sheet after the purchase. You can see that I spent some money. That's why my checking account went down. My construction escrow is now full. I'm ready to do my renovations. I have my $75,000 hard money loan, okay? So I'm kind of ready to go with this. So I can do my renovation, right? So your renovation is going to take the shape of many different expenses or checks that you're writing to your contractors. So for example, I might write my electrician a check. And notice here I'm using products and services. I recommend you do that. If you haven't seen a video on that, check that out. This is going to give us an immense amount of detail. So let's say that I'm spending money on rough electric, and for the time being, I'm paying out of my checking account. And let's say that I spend $15,000. Okay, and this is for property called 34 Long. Okay, and let's just go ahead and do that. Okay, so now notice that that doesn't show up, and actually let me just, that doesn't show up in my balance sheet section, it actually shows up in my net income. And why is that? Let's drill down and find out. Well, I currently have mapped my products and services to go to an expense account, a cost of goods sold account, okay? And this is what you would typically do if you're flipping houses. Now, for a rental property, you're probably going to want to add this amount to your CapEx, to your fixed assets, but it doesn't mean you need to reroute the entire architecture of your books. Keep it like this, and then when you're done with the rehab, we can do a journal entry to move it over. I'm gonna show you exactly how to do that. Okay, let's do another expense because I have about $30,000 to spend in construction escrow. Let's pretend I spend exactly that much. So let's just do one more expense, and this will be for rough plumbing for another $15,000. Okay, so let's just say it's Lowe's. Obviously, I wouldn't pay Lowe's for rough plumbing, but just for simplicity here. Okay, so let's go with, okay, now notice this is my whole list of products and services. Again, if you haven't seen that video, check it out. We get tremendous value from that. Okay, another $15,000. I'm going to put this toward my 34 Long reno. And I'm going to save and close that. Okay, so now I've been spending out of my cash there, and I show a negative net income of $30,000. And again, that really isn't how it should look. Now, you could reroute your products and services to automatically hit your balance sheet. However, if I'm doing some flipping and I'm doing some rental properties, you're going to need to do some journal entry adjustments eventually. So right now, this is showing up in my net income, and I can drill down into this, and I can see I have my rehab costs. I can drill down into this. I can group it by products and services, and I get all this cool reporting, okay? Now, let's say that I want to move this to my balance sheet. It's actually a really simple journal entry, okay? So whenever you're done with your renovation, you're going to do a simple journal entry to move this $30,000 from your profit and loss to your fixed assets in your balance sheet, okay? So really simple journal entry, and we're going to do this at the time that my renovation is complete, or it's often referred to as the time that the building goes into service, okay? So I'm going to pull up my CapEx account, CapEx original, 30,000, okay? And then I'm going to take it out of my expense account, my rehab costs account, okay? So when I do that, and I'm not worried about classes right now. Okay, so when I do that, notice my net income goes back down to 0, and now I have 30,000 in CapEx on my balance sheet, okay? So that's looking pretty cool, right? Now the other thing that would happen at some point here is that my lender, my hard money lender, is going to pay me back for those expenses I incurred, okay? And so that would happen through a series of draws, potentially. Let's pretend that they just pay me back in one lump sum at the end of the project, okay? So how do we record that? Again, simple journal entry. We'll do it at the same date here, and we're going to take our construction escrow, which is an asset. We're going to credit it, meaning we're decreasing it. And where does the money go? They're reimbursing us. They're putting this back into our checking account, okay? So we've finished our rehab, and we've gotten paid back from our lender to bring our checking account back up. So my construction escrow is zeroed out. I have my building, my closing costs, my CapEx. Here's my hard money loan. Now, a hard money loan, you're probably not paying down principal as you go. You might just be paying interest on it, okay? So now we are ready to refinance. So what we're going to do is we're going to refinance this property into another entity, okay? So another entity is going to be on title, and another entity is going to have that loan. So what do we need to do? Before we prepare for this refinance, and it's the same if you're preparing for the sale. When I say preparing, I mean preparing to make the entry. We need to take note of what is on our balance sheet. So we see that we have $45,000 in buildings. $2,500 in closing costs, $30,000 in CapEx, all under this entity, okay? We also have a $75,000 loan. We need to, by the time this refinance is complete, we need to zero that out, okay? Because the deed is transferring over to another business. Okay, so we're gonna go through this in a few steps. So I'm gonna start to record this sale. Now let's just take a look at this and let's think of something that might be realistic. So I bought it for $45,000. I put $30,000 into it, so I'm into it $75,000. Let's say that this thing appraises somewhere in the $100,000 range. Let's say I get a refinance amount of $150,000 new loan. Okay, that'd be cool, right? Let's do $100,000 loan. Let's say it appraised for $150,000 and I got a loan for $100,000. Okay, so let's add that journal entry. So this is going to be for a new business, okay? When I say a new business, I'm using location tracking to do that. You've seen me using the business over here, okay? So the first thing I would like to do is I need to zero out my balance sheet for the old business. So I know that I have a building that I have on my books for $45,000. So I'm going to decrease by $45,000. And this is currently in the old business so far. Okay, I also know that I have closing costs in the amount of $2,500. I need to zero that out. All I'm doing so far is zeroing out my fixed assets for the one building. There's my CapEx. Okay, so now that's going to be zeroed out. What else is happening with this purchase? Well, I'm also zeroing out the loan for ID Property Management. So that hard money loan, that is going to be decreased by $75,000. And my CapEx, I'm sorry, is $30,000, not $45,000. Okay? All I'm doing is zeroing these out. There's no magic to this quite yet. All right? This is all the ID Property Management stuff. So we're wiping all of this clean. Now let's think about the new business. So the new business now owns a property, right? So we're pretty much just going to transfer this over to the new entity, okay? So here we can do buildings, original cost. Now here you could either do $45,000 into a separate line for closing costs of $2,500, or you can combine them into one. It probably doesn't matter. I'm going to keep them separate. And just talk to your CPA as to what makes sense about that. It probably doesn't matter much. Okay, so there's my building. Here's my closing costs. Okay, here's my CapEx. Now this CapEx too, again, this CapEx, you might want to add it to the original cost. Again, I would go to your CPA for guidance there. It's probably easier to do it this way as I'm doing it and then reverse it later. Okay, so this is coming onto my balance sheet. Let's say that I'm also getting a loan for $100,000, okay? So I'm getting a conventional first mortgage for $100,000. Okay? Whoops, not a million. All right, so things are kind of starting to take shape. And I always say start with what you know, right? So what we know up here is that we need to zero this out. And I don't know why I put 78,000. Let's put 75,000. All right, we need to zero all of these out. And then we need to add these to our balance sheet. We know what the building costs, the closing costs, and then the CapEx. Now on this refinance, I probably have additional closing costs, right? That's probable. Okay, so if you have additional closing costs, you could put in a new line item for all of those additional closing costs. Let's say it's like $5,500, okay? And then what else is happening here? Well, I could potentially get cash back at closing, right? Because my loan amount is more. So if I do get cash back at closing, here's my loan, okay? And I'm going to get cash back at closing, so I can go and do my checking account for this new entity, 34 long checking. Let's say I get $19,500 back at closing, all right? So this is like almost done. The balance sheet works out. My debits and credits equal each other. And in theory, this is kind of accurate. But we're going to have a little bit of an issue, which I'm going to show you. So I'm going to save and close this for now so we can see how this looks on the balance sheet. What I want to see is on the one hand, ID Property Management, which is over here to the right, I want to see 0 in fixed assets, which is good. I see nothing in building, nothing in closing costs, nothing in CapEx, and nothing in loans, okay? So that looks good to me. And then I look over on 34 Long LLC, and what am I seeing? Here's the cash I got at closing, here's my building, here's my closing costs, here's the CapEx. So I have a total fixed assets of 83,000. My total assets of 102,500, and here's my conventional mortgage. So we're in like pretty good shape here, except one thing. Now, if you're doing this on a separate subscription, you wouldn't have been able to get this far without doing the step that I'm about to show you. Each of these businesses needs a balance sheet that adheres to the fundamental accounting principle, the fundamental accounting equation. And what is that equation? That is that assets must equal liabilities and equity. And you can see here that's simply not the case, okay? That the assets for 34 Long LLC are greater than the liabilities and equity, and vice versa for ID Property Management. That means something is amiss, and it'll make itself clear when we dig down into that balance sheet journal entry one more time. So I'm going to go into that journal entry, and we're going to just make this one correction that's going to fix everything, okay? And this will make itself clear if we kind of take one business at a time. And what do I mean by one business at a time? So if I were to pretend that the 34 Long stuff isn't on here, and I were to add these up, I'd see 45,000 plus 30,000 plus 2,500. That equals 72,500. My credits are 72,500 for ID Property Management. That's $2,500 short of my debits. So I'm going to need some kind of credit in the amount of 2,500. And so all we're going to do with this is we're going to create an equity account between the businesses that's almost going to be like one business investing in the other, okay? So I'm going to create this account called Intercompany Equity, 34 Long LLC, and ID Prop Management, okay? And I'm going to add that, and I'm going to treat this as an equity account. And we'll do partners equity, okay? And let's go save and close on that. Okay, so I'm gonna bring this up, and I like to have all of my business stuff close to each other. I'm gonna make this one an ID Property Management. And what I was saying before is that the total of my credits for this business need to equal the total of my debits, and I'm $2,500 off, okay? So I'm gonna add that in there. Okay, now my 2,500 plus 2,500, that's 5,000, plus 45,000, that's 50. That's 35,000 plus 45,000. Okay, so we're getting close. Okay, and then we're going to do that 34 Long LLC, intercompany equity, will show up there as well as the debits, okay? So now you can see that everything is matching. I'm gonna hit save and close. And actually, I think I just did it reverse. Okay, I'm gonna check this out. I think I just did it the complete reverse, but don't worry, we can fix it. So let me just see what happened here. So again, the way that you know if everything works is if you do your assets equaling liabilities and equity. And like I said, I think I just threw it off. Yep, I just threw it off a little bit extra. So I just had to reverse this. All right, so bear with me. This is kind of confusing stuff, and I just reversed where the credits and debits went. Okay, so this 2,500 actually belongs over here. This 2,500 belongs over here. So my math was off there, okay? So we want this to be the 77,500 now equals this 77,500, and same thing down here, okay? Apologize about that. So now we go back to our summary report. My assets and my liabilities and equity will equal each other perfectly, okay? So I've successfully transferred the asset from ID Property Management over to 34 Long LLC, and I've also kept our balance sheets equal. So what does this tell me down here, this 2,500 positive and then negative 2,500? It pretty much means that ID Property Management money left the business, $2,500 worth, and then 34 Long LLC, money entered the business. It's almost the equivalent as if you were to put cash into one of your businesses as an owner investment. This investment is just coming from the other business itself. Okay, so thanks for staying with me on that. A little bit of a complicated concept, but this is what's cool about those who are in Real Estate Accounting Bootcamp. We can ask these complicated, nuanced questions about really challenging real estate investing scenarios, and we're able to answer them right here on these videos, okay? So let me know if you have any situations like this. If you have any questions, just post them in the comments, or you can email me directly at nick@incomedigs.com, and we'll see you on the next video.